This podcast is intended for investment professionals only. All investing involves risk. Hello, and welcome to L&G Talks Asset Management. Factor investing has grown over the decades, and today more than $1.5 trillion is invested in these strategies. At the same time, an increasing number of investors have taken steps to reduce the carbon footprint of their portfolios. This raises an important question. Can equity factor strategies be decarbonised without compromising their return objectives? Today, I'm delighted to be joined on the podcast by Raj Shah, a senior quant and factor strategist within our index solutions team, who has just published in-depth research exploring this topic. Raj, welcome to the podcast. I wonder if you can tell us a little bit about the motivation for this research, the factors you explored, and the methodology that you employed to dig into this topic.
Oh, thanks, Harry. Thanks for having me here. Just to sort of start with, you're spot on. Over the past 10 to 15 years, factor-based strategies have really taken off. And why? I think there are three main reasons there. One is explosion of data. So it's so much data available, as well as the quality. We think of it like as, if you think about like the availability of data now compared to 10 years ago, it's so much better, so much cleaner, and so much more with different companies. And then you also have faster computing power now. So you're able to crunch the numbers much quicker, score companies much quicker. So in this research, we really focused on four popular factors. One is value, so quote unquote, cheap stocks. The second one is quality. The third one is low volatility. So think of stable stocks like consumer staples. And the fourth one is momentum, thinking of riding the wave of trending stocks. And the index solutions team has written a few blogs diving into these factors recently. But that's not all. There is a growing trend towards decarbonized investment strategies. Investors are increasingly looking to align their portfolios with sustainability goals like net zero commitments. So for this paper, we used 10 years of data and our factor scoring framework, and we were able to conduct detailed analysis on how climate objectives interact with factor-based investing. And then we compiled the findings into the white paper to showcase the results.
Excellent. So in your white paper, you begin by analysing the typical carbon footprint of the four popular factors that you just mentioned a second ago to see how they have compared historically with a market cap index. What did you find?
So let's paint a picture with this data. We started by constructing portfolios focusing on the individual factors that we've mentioned, so quality, value, low volatility, and momentum. And as we examined these portfolios over time, we also kept an eye on their carbon footprints. And this is what we found. Start with the value factor. The value factor tends to be most carbon intensive. Think of a factory with like these massive smokestacks with high emissions. The quality factor we found was the least carbon intensive. So thinking about these eco-friendly buildings, for example, with like solar panels, etc. on top. And the two factors, low volatility and momentum, these are predominantly price-driven factors, so they show a wide range of carbon footprints. So think about these factors as a mixture of high-emitting factories and eco-friendly buildings, for example.
That makes sense. So when we think about the different sectors that make up the global economy, as you've kind of just covered, really, it's known that particular sectors will make up the majority of weighted carbon emissions. As you just said, materials, utilities, energy. What does sector distribution in typical factor portfolios tell us about the level of intervention that might be needed to achieve a given decarbonisation target?
Great question. So I'm going to start by explaining what we mean by intervention. This word is usually used in a medical context, but let's think about baking a cake. So when you bake a cake, we usually mix flour, eggs, sugar, and butter. You stick it in the oven and then add icing at the end, or in my children's case, you add tons of M&Ms or all of that stuff in the middle these days. But now imagine you had to bake a cake for a diabetic. We would need to substitute all the sugar, the icing, and the M&Ms with alternatives, and then hope it tastes like the original cake. This is what we mean by intervention in this case. So moving back into your question, so back to factor portfolios, decarbonization targets are usually set versus a market cap benchmark or a decarbonization pathway. So now we compare the weighted carbon emissions of the factor portfolios versus the benchmark, and then intervene when the carbon emissions of the factor portfolios are higher than the target. So back to the first part of your question, you mentioned that certain sectors make up the majority of weighted carbon emissions, sectors such as materials, utilities, and energy. Now, if factor portfolios are heavy on these sectors, then the level of intervention would be higher for us to decarbonize these portfolios. So we analyze the sector allocation of the factor portfolios over 10 years. Let's talk about value first. Now, this value factor is typically the most carbon intensive. We find that value portfolios tend to be heavy on financials and energy sectors, but light on information technology. So therefore, the level of intervention needed is typically high. Next up is quality. So this factor often has significant overweights to information technology. So picture a portfolio filled with tech companies that are generally less carbon intensive. So the level of intervention is typically low, and sometimes you don't even have to intervene. Finally, the price-driven factors like low downside volatility and momentum can show a wider range of sector allocations over time, where the mix of sectors can change significantly. For these factors, we see more frequent sector rotation. So the level of intervention varies quite a lot.
Thanks. The cake analogy, baking analogy really helps helps bring it to life. I wish more of my investment colleagues could come up with that kind of stuff. So let's imagine, for the sake of argument, that I want to pursue a value factor strategy. But as a diligent investor, I've of course read your research, and I'm aware that this might entail a relatively large carbon footprint. What methods might I look to use to decarbonize a factor strategy?
Yeah, this is what we mean by the intervention, right? So how can I change the original factor portfolio to meet my decarbonization targets? So in this paper, we explored two methods that can be used to decarbonize a factor strategy. The first one is exclusions. This is pretty straightforward. You just exclude the highest emitting stocks until the decarbonization target is reached. The main downside for this method is that it tends to penalize only the most energy intensive sectors. Another popular method, that the second one that we use, is tilting. And in tilting, what we tend to do is you tilt the allocations towards lower emitters and away from higher emitters until the decarbonization target is reached. By also applying sector constraints, it's possible to limit extreme sector deviation from the original factor portfolio. This method also tends to avoid outright exclusions. Now, the sharp-eared listeners may be wondering why we haven't spoken about optimization, which is another popular method used by practitioners. At L&G, we generally prefer to use tilting with an optimization overlay to preserve the proportionality between factor scores, carbon intensities, and the final allocations to the stocks.
So in the research, as you've mentioned, you looked at both exclusions and tilting, and you used these methods to try to achieve a 50% carbon reduction versus a market cap based index, which brings us to the $64,000 question, I suppose. Were you able to achieve this decarbonisation target while retaining the underlying risk and return characteristics of the factors in question?
This is indeed the $64,000 question. And spoiler alert, the answer is yes, but there is more to it. So let's focus on global factor portfolios. From the analysis, we drew three conclusions. First one is that both exclusions and tilting methods succeeded in achieving the decarbonization target of 50% versus the market cap benchmark across all time periods. Second conclusion is that factor characteristics remain largely unaffected after decarbonizing, so be it via exclusions or tilting. So we don't see material changes to the factor scores after intervening, which is quite important. And then lastly, the third conclusion is that we did not observe significant differences in risk-return characteristics when decarbonizing the factors. So the risk-return profile of the factor portfolio after intervening is similar to the original factor portfolio. So the main takeaway in this case is that when you're looking at global diversified portfolios, investors can align their portfolios with net zero carbon reduction goals without compromising their return objectives.
So I'm sure listeners will have picked up on the caveat there of global, large, diversified portfolios. If we turn to regional portfolios. Does that presumably complicate the job of decarbonising a factor strategy? And are there any particular markets that stand out which might be particularly tricky to decarbonise?
Oh yeah, no, that's exactly it. And I focused on global diversified portfolios, but let's go to the bottom, right? Let's start with individual companies. Now, in the universe, in the world, there are many companies that exhibit strong factor characteristics, but also exhibit high carbon intensities. So these companies would therefore tend to be underweighted when decarbonizing. Now, we refer to this as a tug of war. Now, it's a tug of war between factor investing and meeting your climate objectives. So if we talk about regions such as North America or UK or Japan, some regions will have diverse sector allocations and some regions less so. So I'll take the example of the UK, right, the home market. Now, the UK stock market is heavily skewed to energy and financial companies. And therefore, achieving the three goals of maintaining factor characteristics, preserving the risk-return profile, and reducing the carbon intensity can be challenging in such regions. And we found similar challenges in regions such as Asia-Pacific, ex-Japan, and emerging markets. So when portfolios become less diversified, meaning that you have less to choose from in terms of companies, the tug of war between maintaining the factor characteristics and maintaining the risk return profile while achieving your carbon objectives becomes more pronounced. So in contrast, as I explained earlier, diversified global portfolios can better balance these goals. But for more concentrated portfolios, reducing carbon intensity while maintaining factor characteristics could become quite challenging.
Now that you've published this paper, which I do encourage listeners to read for themselves, if you search Raj Shah LNG, you'll find the paper. I'm interested to know what's next on your team's research agenda. Are there other aspects of this subject that you'd like to explore in more depth?
Oh yeah, absolutely. I think this topic is just, this is just the beginning. If you think about net zero pathways, for example, that 50% is just the start. The net zero pathway will start decarbonizing more and more. So let's say even for a global diversified portfolio, we're then going to start investigating if you decarbonize by 70, 80, 90%, do you then start seeing the tug of war between your risk return objectives and your climate objectives becoming a lot more pronounced even in a global diversified strategy? So that's definitely one angle we're looking at, and we want to try and understand how to prepare for this. So does it become like, do investors then need to choose or between achieving their factor goals and climate goals at some point? Or is it possible that at some point it's just not possible to achieve all three goals? So that's something we're keeping an eye on.
Well, it sounds like we can expect plenty more research papers from you and the rest of your team in the near future. Raj, thank you so much for taking the time to talk to me today. And thank you to all the listeners as well.
Thanks, Ari. It's great to be here.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of L&G's asset management division, as at the date of publication. This podcast is for informational purposes only, and we're not soliciting any action based on it. The information discusses general market, economic, or political issues, or industry or sector trends. It does not constitute research or investment, legal, or tax advice. It is not recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against L&G in relation to the accuracy or completeness of the information contained in this podcast. Where this podcast contains third-party information, the accuracy or completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person in any jurisdiction where such distribution would be contrary to local law or regulations. Copyright 2025. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. Unless otherwise stated, references herein to L&G, we and us are meant to capture the global conglomerate that includes, in the European Economic Area, LGIM Managers Europe Limited, authorised and regulated by the Central Bank of Ireland as a UCITS management company pursuant to European Communities Undertaking for Collective Investment in Transferable Securities Regulations 2011 as amended, and as an alternative investment fund manager pursuant to the European Union Alternative Investment Fund Managers Regulations 2013 as amended. In the USA, Legal & General Investment Management America, Inc., a US SEC regulated investment advisor. In Japan, Legal & General Investment Management Japan, KK, a Japan FSA registered investment management company. In Hong Kong, issued by Legal & General Investment Management Asia Limited, which is licensed by the Securities and Futures Commission. And in Singapore, issued by LGIM Singapore Pte Limited, company registration number 2022318776W, which is regulated by the Monetary Authority of Singapore. For full terms and conditions, please visit our website. To find more content, you can check us out on LinkedIn or on our website.